Hello, welcome back to WINFX Trading YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic markets. In today's video, I'm going to introduce you to discrete candlestick time frame trading strategy. Before I continue, if this is your first time of visiting this channel, do your best to subscribe and turn on the bell notification so you get notified each time I upload a new content. Try to refer your network to this channel so that YouTube pushes to high level of audience. Okay, I think one of the ways to become successful at the speed of light is to leverage the effort of others, and a lot of people have been making money in our VIP channel. It is called VIP Telegram channel. Actually, if you really want to make it in this life, you need to depend on somebody. And the truth is, you really need to depend on something before you can depend on your own, before you will start on your own. So make money somewhere, start somewhere, don't be jack of all trades. You really need to be in our VIP to succeed, right? Okay, so this time around, this content is great, and I think the best way is to put it into practice. The document I will read first, and we'll go to practical chart. Locate key levels in daily on H4, wait for open price. Locate maximum wick in the vicinity for SL placement. TP will be at the close price of the candle. Proper risk management, PRM, can give you an edge if you target 1:5 plus. Okay. So we are going to the practical chart to see how this thing can be, realized. Very necessary, because reading documents, that's not where it ends. Okay, right now I am on the MT5. I will talk on synthetic, then I will also shake on Forex markets. Okay, so which asset am I going to open? One of the popular assets. I'm going to choose asset based on volatility and the one that is most lucrative, and the one that changes by the highest percentage in daily, like on daily basis. So I will use volatility 250-1S. This asset changes by up to 40% per day. 𝑽𝑗75 pretty much change by just 5% to 10% per day. It can't go beyond it can't go close to 20%. But this asset, in a day, it can change by or as high as 40% or more. Okay, so just in a day. What if in a month? What if, let's say, from weeks to months or year? Imagine. So that's why I select this asset. But 𝑽𝑗75 is, when it comes to when we compare 𝑽𝑗75 and volatility 251S in terms of maximum lot size, they have the same maximum lot size, which is 1. Maximum lot size per position, they have it as 1. I'm just trying to, the truth is, 𝑽25-1S has beaten it has overtaken volatility 75 index. It has done that. Okay, that's why I selected it. Is an asset for big investors. If you think you are super rich and you think you can take risk, you want to make more money, this is the asset you should try. Okay, this asset can destroy any type of account, whether big or small, in a matter of few minutes, if you don't know what you are doing. But why I select it is because I want to select asset based on maximum volatility, maximum change, daily change or change per day, and lucrative nature of the asset. Okay, now based on the document, I say you should be on the daily time frame or the H4 time frame. So I want to use, in this video, I'll be using daily time frame so that we get high risk reward. Okay, so because my target is 1:5 plus. Okay, Now, we talk about key levels. Key levels here means area of rejections. In other words, these are resistances and support area in the daily time frame. Okay, there are resistances and support in the daily time frame, and this thing is going to be more reasonable and realistic if you trade it in the direction of what? Trend. Okay, so always look for conditions in the direction of the trend. So you mark, check in the daily, where are you seeing a strong rejection areas that has a lot of wicks rejection. Candle will come there and get rejected and form wick. Candle will come there and get rejected and form wicks. So here we have this area. Okay, we have this area. Okay, we have this area. So this area reject price. You see price flow from left to right. So this area reject price for 2 days. Okay, 3 days. We have this area rejected price for 3 days. 1, 2, 3. Now, take for instance, you want to okay, for 2 days. Let's assume you are following from left. So first day you are observing the market, it did this. The second day it also did this. Like you have 2 points. So we use these 2 points to draw this area. Okay, we use these 2 points to draw this area. Okay, now the next day, which is the third day. Okay, third day. This is first, second, and then the third day. We're expecting a candle to open somewhere here, or even if it didn't open at this key level, we're expecting candle to open somewhere else and drop or come to this key level. Once it comes to this key level, we are going to plan our trade. What do I mean by planning trade? When you are planning trade, you are planning your entry price, you are planning your stop loss, you are planning your take profit. Okay, now the major issue here is what will be the lot size, the total lot size you are going to use. Okay, there is formula to calculate lot size. I will just touch it a little bit, like I will bring the formula to make things easier. So let's go and see the formula before I continue, because it's very necessary. Okay, this is the formula to calculate the lot size. Percentage risk upon equity all over stop loss pip upon pip value. For volatility indices, the p value is $1 apart or except step index whose pip value is $10. Okay, now the percentage risk. If you really want to succeed, because you are actually targeting 1:5 risk reward, like at least 1:5 risk reward, 1:5 plus, you must make sure you reduce the risk, because the signal you are producing is based on a single candle, so it can fail in, let's say, 2 to 3 rows. But if you manage to get one correct, and because you risk 1:5, you will recover all the losses and still make profit. Let me show you why. If you lose in 2 to 3 rows, then this is why you are going to still break even and make profit. I'm going to show you. Okay, this is the simple mathematical principle that we have here. Okay, now trade 1, trade 2, trade 3 is equals to loss, right? Trade 4 is equals to win. Now let loss be equals to or equivalent to KR, where K is equals to 1,1,1 is a kind of count. Now the R is equals to risk. This risk can be in dollars or in percentage, but basically it is assumed that you have calculated the risk in dollar. Okay, cool. And the risk is constant. It is assumed that the risk is constant. I'm going to elaborate on this more. Okay, so total loss will now be 3R, and profit on trade 4 will be equals to 5R. Then the net profit will be the sum of these values. Every loss will be a negative and every profit will be a positive, and when you sum it together, you will have 2R, meaning that you are topping, like you are topping your account by 2R. You are risking something and you are getting 2 times, even when you have lost 3 trades in a row. Okay, and the fourth trade you took, you still risk the R. So for this to make sense, you are risking a constant, you are like risking at a constant rate. Okay, so you can see that without proper risk management, you are going to lose more money with this strategy, because you are actually using resistance and support and monitoring single candle. Okay, so right now I'm going to take you back to the chart so that we continue. Now, on that third day, you are actually waiting for candle to open within this zone you have drawn. You see, if you're the question now is, how do we get the proper zone? How do we draw the proper key level? You just look at differentials between endpoints of wicks and connect those differentials. Use it as the height of the zone. That's what I did. You see, this one ended here, this one ended here. Then I joined it together. Then I'm waiting for a candle to open inside this zone, whether on the surface or in the middle or elsewhere. Once it's connected to this zone, if it opens here, I'm going to trade it in the direction of the rejection from that key level. So I'm going to buy. Okay, and then the stop loss will be about the extreme wick, like the wick that have, like that is extreme. Any wick that is extreme to that zone, that means the stop loss should be outside the zone. Basically, if you do it relative to this wick, then it should be outside the zone. Basically, whether relative to any wick or not, it should be outside the zone, because you should give it a little bit distance outside the zone, because you believe that price cannot break that zone. So you can let's assume we entered immediately the wick drop here, because it opened outside the zone, but we are now waiting for the wicks to drop, right? So you enter somewhere here. Okay, enter somewhere. This is the surface, and then you put it here. You know, you are on daily time frame. The pip value, I'm sorry, the stop loss pip can be very large. You know, the third number here is the stop loss pip, 13,470. And then once this candle close in the day, you have generated 80,000 pips while risking 13,000, you know, let's call it 14,000. Okay, and you see the risk reward. If you divide 80,000 by 14,000, let's go to calculator and check. Well, okay, you can see the risk reward is approximately 1:6, basically, because all the numbers we approximated, right? So you can still approximate the result to get 1:6 risk reward to nearest whole number. Okay, so this idea is risky. You see, the next day you want to try it, the candle open here and then drop, and then you want to try it, it failed. That is where risk management is very important. So the golden rule is you should risk 5% of your equity, you know, so that it will take you 20 trading sessions to blow your account. 20 trading signals or sessions to blow your account. And you know, it's hard for you to actually lose 20 trades in a row. And the limit here is that you shouldn't lose 5 trades in a row. If you lose 5 trades in a row and you were able to win the 6th trade, you basically break even. Like, you make no profit, you make no loss, because it is now 5R minus 5R. Are you getting me? So that's good. Now look at what is happening here. We see that this area hold price. I say you should follow trend based on block theory. We have this block has been broken, and because the breakout is in the downward direction, pointing downwards, then the market is trending downwards. Once a block is broken, it becomes a trend, right? So it's trending downwards. So I say you should follow the trend, right? Why I bought on this one is because the market has been buying along this path. So this is now a bear market, right? So we are now waiting for the day to open because we have spotted this area as being so, resistive. Like this is a very strong resistance, and we're waiting for price to tap into this zone. Whether it is on the boundaries or on the surface, it doesn't matter. So we have this candle that open here, man. This candle open here. I don't care about the wick it generates. All I need is to enter immediately. It opens, okay, and then put the stop loss outside the zone. I'm risking 21,000, 22,000, 23,000 pips. Yeah, 23,000. At least I need to give it a space between the endpoint, the boundary of the zone and the stop loss. All right. So it's going to be here, risking 22,000 pips, and when the day closed, we were able to generate 76,000 pips. So what's the risk reward? We are going to go to calculator. 76,000 divided by 23,000. So the risk reward is 1:3.3. So you see, the risk reward basically falls here. Now the truth is that this tends to generate like if you study the truth table of losses and profit, the win rates tend to approach more than 90% because if you follow the rule of trend and trading at strong key level using the daily time frame, like you see the win rate approaches 80 to 90% of the time. So when you have such win rates, don't expect the risk reward to be 1:5. The ones you have been winning will replace the low risk reward signals, okay? But don't trade risk reward of 1:2. 1:3 to 1:5 is cool. At least if you have 1:3 most of the time, then 3R minus 3R will be 0, meaning that you have to lose 3 trades, and then for you to like break even. If you lose 3 trades in a row, you break even, and then the fourth trade will actually recover the losses, and then you break even. That's good. I'll be going to Forex market because of this video is taking pretty much time. Okay, this is Forex market. Let's open Bitcoin. You see, today is Sunday. Forex is going to open around from 10 p.m. to near 12 midnight, 11:59 p.m. Okay, so Bitcoin is traded 247. So I'm gonna use Bitcoin. Basically, I can use any other asset, but I need something that is basically active right now, in case if I can show live result. Okay, so though I can still touch other assets that have closed. So let's open BTC. So this is BTC. You see the power of this strategy. We are just looking for a strong support or resistance, and we want to trade in the direction of the trend. Okay, so you can see this market has been making higher high. It has been going up. So here I'm gonna mark this area. This is a very strong I'm gonna use this. So this is a very strong resistance. Okay, when you are drawing resistance, you have to make some assumption. Based on how price is swinging. Okay, you can extend your area just to accommodate certain things. Okay, this area play a role in the stop loss calculation. So stop loss pip calculation. So here we have this candle that opened near this upper boundary of the zone, So immediately it opens. I'm not talking about the bearish candle. I mean the white candle. Immediately it opens, you enter here and you place your stop loss somewhere here. So you risk 955 pips while you're targeting when the candle closes here, or you were able to predict a high, whatever. But basically, we are talking about the closing price. But most time, if you notice that a candle is forming wicks near the close of the day, maybe the last 4 hours or the last like second to the last, like the last 4 hours, like price is rejecting, then you can take your profit, because you know most time it might reject and form a very long wick, and then all your profit will turn to loss. So see here, this is the closing price. So we're able to generate, basically if you look at the maximum price, we're able to generate over 2,000 pips. That is 1:2 risk reward. Okay, but you can use optimization theory, whereby you can locate your L cell in the mid, just below the middle of the midpoint of the zone. So here you are risking 458, and if you now check 2,000 divided by 458, so the risk reward is basically 1:4, which fall in the range of 1:3 to 1:5 plus. Okay, that's good. You know, you see, when this idea is optimized, you can actually use it to stage for long term. If you understand what the market is doing, you can basically use this idea to stage for long term. Imagine holding this trade and generating close to 9,000, let's call it 9,000 pips, while risking 900 pips, for instance. Okay, 458 as we optimize the middle, at the middle. So we have 9,000 divided by 458. So the risk reward is approximately equal to 1:20. Say you have a $1,000 account and you risk 5%, which is the $50. So you divide the $50 by SLP, which is 458, multiplied by 1. The p-value of BTC USD is 1. Basically, the loss size you'll be using is 0.11 if you approximate it. But we don't care about this loss size, but we care about the risk reward. So 50 times 20. So basically, your $1,000 account must have been doubled just by risking 5%. What if you increase your risk to 10%? Let's assume you want to take a serious risk. So you basically, you are now getting you're not risking $100, and then you are getting $2,000, and then your $1,000 has been tripled based on return on investment, because you have to add this $2,000 to the original balance. That will be your return on investment. So we say your balance is tripled because it's no longer $1,000, it's now $3,000. Okay, you see, this is for celebrity purpose. There is no guarantee that this will be working perfectly, but there are a lot of facts in the video. If you read, if you really need solid profit, consistent profit, if you need fire, like signal that come with fire, like these are high risk reward, like the risk reward is high, the reward is big and the risk is small. If you need such signal on jump indices, volatility index, jump volatility is like V10 to V100, and their 1S counterparts, step index, forex market currency pairs like we started GBP USD, GBP JPY, gold USD, silver USD, all these currencies in the forex market. If you really want to become successful, you need to join our VIP. We have basically about 4 groups: one on forex and synthetic, then one on boom and crash. We have one on binary option trading, Inside binary option trading, we have different type of markets depending on what you want. So you have to start, prioritizing your needs and your financial freedom. Thank you and bye for now.